the 6-day clock. Look, I've been analyzing commodity markets for 12 years now, and I can tell you with absolute certainty, what we're seeing right now isn't normal. It's January 25th, 2026. The government shutdown clock is at 6 days, and while most people are going about their Sunday, the machinery that keeps the global financial system running is starting to lock up. The briefing rooms in DC are quiet, too quiet. There's this eerie stillness that happens right before something breaks. I've seen it before, but never quite like this. The mainstream narrative wants you to believe this is just another budget fight, another political stalemate over the Minneapolis situation. They're telling you the Treasury has everything under control, that this is all standard procedure. But this morning, a few hours ago, I was looking at the data. Real data, not the sanitized press releases. And what I saw tells a completely different story. We aren't just looking at a government shutdown. We're looking at something I'm calling a data blackout. And here's the part that should make your blood run cold. When the government turns off the lights on January 31st, the Federal Reserve goes blind. No jobs reports, no CPI data, no official oversight. The economic dashboard just goes dark. In that darkness, the physical metals market, which is already stretched to an absolutely breaking point, is about to experience a black swan event that the paper markets are completely unprepared for. While the headlines scream about politicians and their theatrics, the real signal is buried in a 15% interest rate that should not exist in a healthy market. But we'll get to that. Here's my primary claim, and I want you to understand how serious this is. We are witnessing a direct collision between a total government data blackout and the most severe physical silver shortage in modern history. This is the catalyst for a permanent triple-digit floor for silver. I'm not being hyperbolic. The stakes are that high. Gold is literally hovering at the $5,000 doorstep right now, $4,982.49 as of this morning. Silver just shattered the $100 ceiling decisively. It's trading at $103.07. This isn't just a rally. This isn't just momentum. This is a structural realignment of the entire precious metals market. Now, here's what I'm going to do in this breakdown. I'm going to explain the lease rate mechanism that proves the vaults are actually empty. I'm going to run the stress test math on the COMEX delivery failure scenario. And I'm going to show you exactly what my personal conditional plan is as we approach this January 31st deadline. Let me be crystal clear about something. I'm not here to give you financial advice. I'm not a financial advisor. I'm here to share my research, my analysis, and show you how I am personally navigating the next 144 hours. Because to understand why the price is moving the way it is, you have to understand the hidden interest rate that is currently screaming fire in a crowded theater, and almost nobody is paying attention to it. Let me teach you about something called metal lease rates. This is the interest rate that a big bank or an industrial user pays to borrow physical metal instead of borrowing cash. Stay with me here, because this is the key to understanding everything that's happening right now. Under normal market conditions, these rates are near zero, sometimes even negative. Why? Because there's usually plenty of metal to go around. The vaults are full, supply is abundant, borrowing is cheap. But right now, platinum 1-month lease rates have absolutely exploded to 15.83%. Let me give you an analogy to make this crystal clear. Imagine you walk into a car rental counter. You're just trying to rent a basic Toyota Corolla. Normally, that costs you $50 a day. Pretty standard, right? Suddenly, the clerk looks at you and says, that'll be $2,000 a day. You'd think they made a mistake. You'd say, oh wait, I just want the Corolla, not a Ferrari. And they'd respond, I know, but there are only 2 cars left in this entire city. There are 5 people standing in line behind you, and you all have to get to a wedding today. That's what a 15% lease rate means. This isn't about the intrinsic value of platinum changing overnight. This is about scarcity. This is about desperation. The big money, the institutional players, the banks, the industrial users, they are desperate right now. They aren't borrowing paper contracts. They aren't trading derivatives. They are paying a massive, unprecedented premium just to hold physical bars for 30 days. Think about what that means. These are sophisticated players. They have access to every financial instrument imaginable, but they're choosing to pay 15% just to touch real metal. Now here's where this becomes directly relevant to silver. Silver lease rates are creeping toward 4%. That might not sound like 15%, but in the context of silver's normal lease rate environment, it's absolutely screaming. And when the government shuts down on January 31st, when the paper price discovery mechanism starts to break down because there's no official economic data being released, these lease rates become the only real indicator of actual value. They become the truth that the paper markets can't hide. Look, I want you to pause for a second and really think about this. Pull up the lease rate charts if you have access to them. This morning's data, this isn't a theory I'm spinning. This isn't speculation. This is a physical bank run happening in real time in the wholesale metals market. And if you think a 15% lease rate on platinum is high, wait until you see the math on the contracts that are actually standing for delivery in 4 days. Let me give you the snapshot of where we are. This data was pulled this morning at 8:45 a.m. Eastern. Gold, $4,982.49, up 0.49%. This is psychological warfare at the $5,000 level. The market is testing it, probing it, seeing who blinks first. Silver, $103.07, up a 6.34%. We have officially entered the parabolic phase. This isn't gradual accumulation anymore. This is vertical movement. Platinum and palladium are both up over 3 to 4%. The entire hard asset sector is glowing green while traditional markets are showing serious stress. Here's something critical. The SOFR IORB liquidity spread is narrowing to negative 0.01 percentage points. For those who don't track this metric, that's the spread between what banks pay each other overnight versus what they can get from the Fed. When this spread gets tight or flips positive, it means the banking system is running out of cash. They're scrambling for liquidity. Now, let's talk about the divergence between physical and paper markets. While the screen says $103 for silver, I'm hearing unverified but credible rumors from contacts in the industry that major bullion dealers have literally zero physical 1,000-ounce bars in stock for immediate delivery. Zero. You can't walk in with a suitcase of cash and walk out with a bar. It doesn't exist in inventory. The paper market says $103. The physical market says no offer, meaning at any price there's nothing available. Now, let's address the supposed solution that's being floated around. On January 15th, there was a critical minerals bill passed, $2.5 billion allocated to build a resilience reserve for strategic metals. Sounds great, right? Sounds like the government is being proactive. But here's what that actually is. It's an admission of a strategic deficit. It's the government publicly stating, we don't have enough of these metals and we need to start stockpiling. The problem? They might be 46 million ounces too late for the January delivery cycle. Let me explain why. I know what the skeptics are saying right now. I've heard it all week. This is all priced in. The CME just hiked silver margins to $32,500 per contract, a 47% increase. This will force everyone to sell. The price will crash just like it did in 2011. I understand why people think that. Margin hikes have historically been used to cool off speculative fever. In 2011, when silver hit $49, the CME raised margins 5 times in 8 days. The price collapsed. But here's the difference. In 2011, we had functional supply chains. We had low lease rates. We had plenty of physical metal available. The market was driven by speculators using leverage. Today, margin hikes are being met with increased demand for actual delivery. Let me show you the evidence. There are 9,181 silver contracts standing for delivery in 4 days. That's 46 million ounces of silver that contract holders are demanding in physical form. Raising margins doesn't stop someone who actually needs the silver. It only hurts the gamblers who are trading on leverage with no intention of taking delivery. The industrial users, the institutional buyers, the sovereign wealth funds, they don't care about margin requirements. They need the metal. They're not speculating. They're securing supply. Here's another myth I want to destroy, the flight to cash narrative. People assume that during a government shutdown, the dollar gets stronger because it's the safe haven. In the very short term, maybe that's true. You might see a knee-jerk move into cash, but when the DXY, the dollar index, enters a data vacuum without CPI reports, without jobs numbers, without any official economic indicators, what exactly is cash representing? It becomes a blind bet. You're betting on the value of a currency while simultaneously having zero visibility into the economic conditions that give that currency its value. That's not safety, that's Russian roulette. So if the skeptics are wrong about the margin call crash, if the historical playbook doesn't apply this time, how high does the pressure actually go when we run the real numbers? Let's do the math that breaks the system. We're at the 60% mark of this breakdown now. We've covered the 6-day shutdown clock, lease rates at 15% for platinum and climbing for silver, and silver holding firm above $100. Here's the math that breaks the system. Let's start with the conservative scenario. 9,181 contracts standing for delivery. Each contract represents 5,000 ounces. That's 46 million ounces of silver that need to be delivered in the next 4 days. Now, according to the latest COMEX warehouse data, there are approximately 30 million ounces in registered status. Registered means it's available for delivery. It's not spoken for. It's not in someone's personal vault account. Do you see the problem? We have a 16 million ounce deficit before we even start talking about February's delivery cycle. The math literally does not work. Now, let's run a stress test. Let's say the COMEX somehow scrambles and finds a way to convert some eligible inventory into registered status. Let's say they barely manage to cover January. What happens if even 5% of paper contract holders, just 5%, decide they don't trust the banking system during a government shutdown and demand physical metal? The paper silver market trades millions of ounces every single day. The open interest in COMEX silver futures represents over 1 billion ounces. 1 billion. If 5% of that wants physical delivery, that's 50 million ounces. The price doesn't just go to $110, it goes into no offer territory. There's no price discovery because there's no supply. Now, let's compare this to the government's supposed solution. The $2.5 billion critical minerals bill sounds like a lot of money, right? At current prices of $103 per ounce, $2.5 billion buys you approximately 24 million ounces of silver. That's half of what the COMEX needs to deliver this week. Half. The government's Strategic Reserve Initiative can't even cover 1 month of delivery obligations at a single exchange. I want you to pause for a moment and really internalize this. The math literally does not add up. There's more claim on silver than there is actual silver. This is a fractional reserve system applied to a physical commodity. And we're about to find out what happens when everyone tries to withdraw at the same time. When the math fails, when the system can't physically deliver what it promised, the institutions only have one card left to play. And that card is called force majeure. Let me tell you what I expect to see in terms of institutional reaction. We're already starting to hear whispers, unverified but coming from credible sources, about force majeure talk. There are rumors of a major London vault failing to deliver to a sovereign buyer. For those unfamiliar, force majeure is a legal clause that allows a party to break a contract due to extraordinary circumstances beyond their control. Natural disasters, wars, acts of God. Or apparently, we promised you silver, but we don't actually have it. If a major vault or exchange declares force majeure, what happens? They settle in cash. They pay you the paper value of your contract instead of giving you the metal. That might sound fine on the surface. You bought at $90, they settle at $110, you made money, right? Except you didn't want the money, you wanted the metal. Because you understand that the metal is what has actual value in a crisis. Now, let's talk about the data blackout phase. On February 1st, if no deal is reached in DC, the official economic numbers just stop. The Bureau of Labor Statistics doesn't publish jobs data. The Bureau of Economic Analysis doesn't release GDP figures. The Consumer Price Index goes dark. The Federal Reserve is flying blind. In that environment, watch the SOFR IOR be spread very carefully. This morning, it was at negative 0.01 percentage points. If that spread flips positive, if SOFR rises above IORB, it means banks are paying more to borrow from each other than they can get from the Fed. That's a liquidity crisis. When banks are out of cash, they start selling everything. Stocks, bonds, real estate, crypto, everything gets liquidated, except the one thing they can't replace, physical metal. If they sell their physical gold and silver in a panic, they cannot get it back. Not at these prices, not with these delivery timeframes. So here's my dashboard for the next 6 days. Number 1, watch the $105 level on silver today and tomorrow. If we close above 105, we're in a different regime entirely. That's confirmation of parabolic momentum. Number 2, watch platinum lease rates. They're at 15.83% right now. If they hit 20%, the physical market is officially in a state of failure. The vaults can't support the borrowing demand. Number 3, watch for any official statements from COMEX, LBMA, or major banks about delivery delays or operational challenges. That's code for we have a problem. This is where the narrative shifts from analyzing market movement to preparing for personal survival. Let me share my analysis, my perspective, and my personal plan. I think we are past the point of a normal correction. I've been through the 2011 crash. I've been through the 2008 financial crisis. I understand mean reversion. I understand profit taking. This is different. The combination of civil unrest and the budget deadline is serving as a smokescreen for a systemic liquidity crisis in the metals market. The political theater is the distraction. The real story is the physical shortage. From my perspective, I'm seeing a structural break. The paper market is losing its ability to suppress price because the lease rates are too high. The shorts can't keep borrowing metal to sell into the market when it costs them 15% annually to do so. The mechanism that kept a lid on prices for decades is breaking down in real time. So here is my personal conditional plan. This is what I'm doing. This is not advice for you. This is transparency about my own positioning. If silver dips back to $95 because of a last-minute 11th hour budget extension, if the politicians somehow kick the can down the road again, I personally view that as a gift. I would look to add to my physical position. Not paper contracts, physical metal. Why? Because even if they delay the shutdown, they haven't solved the underlying physical shortage. They've just postponed the reckoning. If silver closes above $105 today, I'm sitting on my hands. I don't chase parabolic moves. I've been burned before doing that. When things go vertical, I wait for the volatility to settle. I let the gamblers fight it out at the top. If the software spread flips positive, if we see that liquidity crisis signal, I'm bracing for a 48-hour dash for cash where everything gets sold off indiscriminately before the metal's moonshot. In that scenario, you might see silver drop to $85 or $90 for about a day or two as leveraged players get liquidated. Then, once the cash is raised and the panic subsides, the physical shortage reasserts itself, and the price goes even higher. That would be the ultimate shakeout before the real move. But here's the thing. I can't time that perfectly. Nobody can. So my approach is to already be positioned in physical metal and then wait for clear signals before making any adjustments. I'm not selling anything. I'm not panicking. I'm watching the data and staying patient. 6 days left. The clock is ticking. And the data is about to go dark. I want to take you back to something that happened in the London metals market that most people have completely forgotten about. March 2020. Remember that? The world was shutting down because of COVID. Liquidity was evaporating across every market. The London Metal Exchange had a problem with nickel. Specifically, there was a massive short position held by a Chinese tycoon who had bet billions that nickel prices would fall. Instead, prices spiked. He was facing margin calls he couldn't meet. The position was so large that if it blew up, it would have taken down major banks. So what did the LME do? They canceled trades. They literally rewound the clock and erased transactions that had already happened. If you had bought nickel at a certain price and the trade was executed, confirmed, settled, it didn't matter. They canceled it. The integrity of the market was sacrificed to protect the connected players. Now, I'm not saying COMEX will do the exact same thing, but I am saying that when the system is cornered, when the math doesn't work, they will change the rules. They have to. Because the alternative is complete market failure and a loss of confidence in the entire exchange system. So when I talk about force majeure risk, when I talk about cash settlement instead of physical delivery, I'm not speculating. I'm looking at historical precedent. The London nickel situation showed us that exchanges will prioritize their own survival over honoring contracts. Keep that in mind as we approach January 31st. Let me zoom out for a moment and talk about why this matters, even if you don't own a single ounce of silver. What we're seeing is a stress test of the entire financial system's credibility. For decades, the system has operated on the assumption that paper and physical are interchangeable, that a contract promising delivery is just as good as the actual metal. This works great as long as nobody actually wants delivery. As long as everyone is happy to trade paper back and forth, the illusion holds. But when people start demanding physical, when they stop trusting the paper promises, the whole structure collapses. This isn't just about silver. This is about trust in institutions, trust in markets, trust in the idea that when you buy something, you actually own it. If COMEX fails to deliver, if major vaults declare force majeure, if contracts get cash settled against the holder's wishes, what does that mean for every other market? What does it mean for bonds, for stocks, for real estate? If the metals market, which is supposed to be the most physical, tangible market, can't honor its commitments, why would anyone trust the far more abstract and leveraged markets? This is a credibility crisis waiting to happen. And the government shutdown, the data blackout, is going to accelerate it because there will be no official narrative to calm the markets. No Federal Reserve spokesperson to say, everything is fine, we're monitoring the situation. Just silence. And in that silence, the physical markets will speak for themselves. The industrial demand factor. There's another layer to this that doesn't get enough attention. Silver isn't just an investment metal, it's an industrial metal. Over half of annual silver consumption goes to industrial applications. Electronics, solar panels, medical devices, EV components. These industrial users need silver to manufacture products. They can't just decide to wait for a better price. They have production schedules, contracts with customers, factories that need to keep running. When you combine investment demand with industrial demand, both competing for a limited physical supply, you create a squeeze from two directions. The investors want silver because they're worried about financial system stability. The industrials need silver because they literally can't build their products without it. And here's the kicker. Industrial demand is relatively price inelastic in the short term. If you're a solar panel manufacturer, you can't just decide to stop making panels because silver went from $25 to $100. You've already committed to orders. You've already taken customer deposits. You pay whatever you have to pay to secure supply. This is why I keep saying the lease rates are the tell. When industrial users are paying 4% to borrow silver for 30 days, they're signaling that they absolutely must have it and they can't get it anywhere else at reasonable rates. Now let me tell you about something that's happening quietly in the background. Sovereign buyers, central banks, government entities, sovereign wealth funds have been accumulating gold at record levels for the past 3 years. According to the World Gold Council, central banks bought over 1,000 tons of gold in 2022, another 1,000 tons in 2023, and the pace hasn't slowed in 2024 and 2025. Why? Because they see the same thing we're seeing. They see a dollar that's being debased. They see a bond market that's overleveraged. They see geopolitical instability increasing. And they're diversifying out of dollars and into hard assets. Now, here's what's interesting. Most of this buying has been in gold, not silver. Silver is a smaller market, harder to accumulate in large quantities without moving the price. But if even a small portion of sovereign interest shifts to silver, if just one or two central banks decide they want to diversify into silver for industrial strategy reasons, the market can't absorb it. There simply isn't enough supply. I mentioned earlier the unverified rumors about a London vault failing to deliver to a sovereign buyer. If that's true, if a government entity placed an order and couldn't get it filled, that's a massive red flag. Sovereign buyers don't just go away. They keep trying. They offer higher prices. They apply political pressure. And if word gets out that a sovereign entity couldn't get delivery, what does that signal to every other sophisticated player in the market? It signals that the vaults are empty. Let's talk about what happens after January's delivery cycle, assuming it somehow gets resolved. February contracts, March contracts. The demand doesn't stop. If COMEX barely manages to scrape together enough metal to satisfy January deliveries, what happens to their registered inventory? It goes to near zero. Then February contracts start standing for delivery, and the exchange has nothing left. This is the rolling crisis scenario. Even if they survive January, they're just pushing the problem forward by 30 days. And each month, the problem gets worse because the physical shortage is real and ongoing. New mine production isn't coming online fast enough. Recycling can't keep up with demand. The deficit is structural. This is why I believe we're looking at a permanent triple-digit floor for silver, not because of speculation, not because of hype, but because the physical fundamentals have shifted in a way that paper markets can't suppress anymore. There's a psychological element to this that's easy to overlook. For years, decades really, anyone who talked about physical silver shortages was labeled a conspiracy theorist, a doom and gloomer, someone who didn't understand how markets work. The mainstream narrative was that silver is abundant, the COMEX always delivers, and anyone worried about physical availability is being paranoid. But when the price goes from $25 to $103 in a relatively short period, when lease rates spike to historic levels, when major dealers run out of inventory, suddenly the conspiracy theorists look a lot more credible. And that creates a feedback loop. People who dismissed the physical shortage narrative start to reconsider. They start asking questions. They start researching. And some of them decide to buy physical metal, which puts more pressure on an already tight market. This is how paradigm shifts happen. Slowly, then all at once. The smart money has been accumulating physical metal for years at low prices. The mainstream is just now waking up to the reality. And they're waking up at $100 instead of $25. That's the price you pay for being late to a structural shift. I haven't talked much about the Minneapolis situation because, frankly, it's a distraction from the real issue. But let's acknowledge the political reality. We have civil unrest in a major American city, we have a budget standoff in Congress, and we have a government that's 6 days away from shutting down. In a normal environment, that would be concerning but manageable. Markets have weathered government shutdowns before. But we're not in a normal environment. We're in an environment where the physical metals market is already at a breaking point, where lease rates are screaming emergency, where delivery obligations exceed available supply. The political dysfunction isn't causing the metals crisis, but it's accelerating it. It's removing the last remaining stabilizing mechanisms. When the Fed goes blind, when there's no official economic data, the algos that trade based on that data start to malfunction. The models break down. The correlations that traders rely on stop working. In that chaos, safe haven assets become even more critical. And the safest haven is the one you can hold in your hand. Physical metal. Not a promise of metal. Not a contract for future delivery. The actual bars. Let me come back to this critical minerals bill for a moment because I think there's something important buried in it. $2.5 billion to build a strategic reserve of critical minerals. On the surface, that sounds like a lot of money. But think about what it represents. The United States government is publicly admitting that it doesn't have sufficient stockpiles of materials that are critical to national security and industrial production. For decades, the assumption was that we could always buy what we need on the global market, that there would always be willing sellers. That price was the only variable. This bill is an admission that assumption is wrong. There might not be willing sellers. There might not be available supply. And price might become irrelevant if the metal simply isn't for sale. So the government is trying to build a reserve. Good idea, in theory. But here's the problem. They're trying to do it at exactly the moment when everyone else is trying to do the same thing. Industrial users are scrambling for supply. Investors are buying physical. Sovereign entities are accumulating. And now the US government is going to wade into the market with $2.5 billion. All of that demand is hitting a market that has roughly 30 million ounces in registered inventory at COMEX and dwindling availability everywhere else. It's like showing up to a store that's having a going out of business sale on the last day and being surprised that the shelves are empty. You're late. The metal is gone. And your $2.5 billion can't materialize metal that doesn't exist. I mentioned at the start that I've been analyzing commodity markets for 12 years. I want to share a bit of perspective from that experience. I got into this space in 2014. Silver was around $19. Gold was around $1,200. The narrative at the time was that the precious metals bull run was over, that the highs of 2011 were never coming back. I studied the market. I looked at supply and demand fundamentals. I looked at the monetary system and the trajectory of central bank policies. And I concluded that the bull run wasn't over. It was just paused. So I started accumulating physical silver, not trading it, not speculating on short-term moves, just steadily building a position. From 2014 to 2020, I watched the price go sideways and even down at times. People told me I was wasting my money. That silver was a dead asset. I kept buying. Then March 2020 happened. The COVID crash. Silver briefly touched $11. I bought more. Then the recovery started. Silver went from $11 to $30 in a matter of months. Then it pulled back again. Spent a couple of years consolidating in the low 20s. I kept holding. Now we're at $103. The lesson I learned, and I'm sharing this not to brag, but to give you context from my perspective, is that the fundamentals eventually win. Paper markets can suppress price for a while. They can create the illusion of abundance. They can trick people into thinking physical shortages are a myth, but eventually reality asserts itself. And when it does, the move is explosive. I believe we're in that phase right now. The explosive phase where years of suppressed price discovery get corrected in months. The dash for cash scenario. Let me walk you through what a dash for cash event would look like, because I think there's a non-zero chance we see this in the next week. If the government shuts down and the SOFR IORB spread flips positive, it means banks are desperately short on cash. They need liquidity immediately. When that happens, they sell anything that has a bid. Stocks, bonds, commodities, everything. Silver, even though it's a safe haven, might see a temporary sell-off because some leveraged players need to raise cash to meet margin calls or satisfy redemptions. You could see silver drop from $103 to $85 or $90 in a matter of hours. The mainstream media would call it a crash. They'd say the bubble popped. They'd interview analysts who would explain that silver was overvalued and this correction was inevitable. But here's what would actually be happening. The paper market would be liquidating, while the physical market would be absorbing every ounce available. The dealers who have inventory would sell out completely. The premiums on physical coins and bars would spike to 30 or 40% over spot. And within 48 hours, once the cash dash is over, the price would reverse violently to the upside because the physical shortage would reassert itself. This is a classic shakeout pattern. Weak hands get scared and sell at the bottom. Strong hands accumulate at discount prices. Then the rally continues, even stronger. I'm not saying this will definitely happen. I'm saying it's a scenario I'm prepared for mentally. If I see that pattern developing, I'm not panicking. I'm looking for opportunities to add to my physical position. There's a concept in markets called no offer. It means there are buyers, but no willing sellers at any price. Usually, this happens in very illiquid markets for short periods of time. A stock halts trading because of news. A bond market freezes during a crisis. But it's rare in commodity markets because commodities are fungible and globally traded. There's almost always someone willing to sell at the right price. We might be approaching a no-offer phase in physical silver. If dealers are out of inventory, if vaults are empty, if industrial users are hoarding supply, who's selling? The paper market can still trade. Contracts can still change hands. But those are just promises. They're not real metal. The real metal might simply not be available at any price. In that scenario, the spot price becomes meaningless. It's the price of a contract, not the price of the actual commodity. The physical premium, the amount you have to pay above spot to actually get your hands on a bar or coin, becomes the real price. And we're already seeing physical premiums at historic levels. American Silver Eagles are trading at $8 to $12 over spot, depending on the dealer and availability. That's a 10 to 12% premium. 100-ounce bars, which usually trade close to spot, are at $5 to $7 premiums. 1,000-ounce bars, which are the institutional size, are simply not available for retail buyers at any premium. This is what the early stages of a no-offer market looks like. So here we are, January 25th, 2026. 6 days until the shutdown deadline. Gold is knocking on $5,000. Silver is holding above $100. Lease rates are at emergency levels. Physical availability is near zero. The COMEX has 9,181 contracts standing for delivery in 4 days, representing 46 million ounces of silver. The registered inventory is around 30 million ounces. The math doesn't work. Something has to give. Either the price goes dramatically higher to entice some holders to sell and convert eligible inventory to registered, or contracts get cash settled through force majeure, or the exchange finds some creative way to delay or modify delivery terms. None of those outcomes are bullish for the paper market's credibility. All of them are bullish for physical metal holders. This is the moment where knowing the mechanism beats following the hype. Understanding lease rates, understanding the difference between registered and eligible inventory, understanding how delivery works. That knowledge is what keeps you from panicking when prices move violently in either direction. The data blackout is coming. On February 1st, if there's no deal, the economic dashboard goes dark. Don't let that blackout leave you in the dark about what's really happening. The physical shortage is real. The delivery stress is real. The lease rates are real. Everything else is just noise. Things are moving faster than most people can process right now, faster than the algorithms can keep up with, faster than the mainstream media can report accurately. If you want to understand the full history of how these force majeure events actually play out in the vault system, if you want to see what happened during previous delivery failures and what lessons we can learn, you need to see the next breakdown. Because the January delivery cycle is just the beginning. February is coming. March is coming. The structural shortage doesn't get better, it gets worse. I'll be watching the markets in real time over the next 6 days, watching the lease rates, watching the SOFR spread, watching for any signs of delivery stress or official statements from the exchanges. This is the moment we've been building toward. 12 years of studying this market, 12 years of accumulating physical metal, 12 years of watching the paper market manipulate price while the physical fundamentals got tighter and tighter. The reckoning is here. 6 days left. Stay sharp.